I look for price. And when you look for price, you more often than not end up looking at least at companies that could go to zero. Because there is something that tells you, there is a situation that increases the risk that the company will go belly up. But while if you look for good companies with a moat and a strong balance sheet and all the good positive features that value investors look at, the risk is, let's say, practically zero. Nestle is never going to go bust. The risk, though, is Coke is never going to go bust. The risk is, however, that you're buying something that is not going to go to zero, but is priced at a level that is not going to give you an interesting return. If you want to have a market-like return, why bother to invest in the first place? Just buy an index fund, right? And in one of my blogs, in one of my posts, I take the example of Coke, which is one of the names that is the quintessential Moat value stock that Warren Buffett has had it for a long time. If you look at what happened there in the 90s, the stock was lowly priced, and that's when Buffett got his position, strong position, and sure enough, the market caught up with that valuation, and the multiple that the market has been paying since then is much higher than the multiple Buffett bought at the time. But in the last 10, 15 years, the stock has basically tracked the market. Why? Because the price reflects the moat. So, Coke is never going to go to zero, but why bother buying Coke if you can buy an index fund, right? The way I look at it is that you want to buy stocks that have a high probability of a very high return, rather than buying stocks that are going to do basically as well as the market. Of course, you may think that the stock will do a bit better than the market, 10% better, but one major take of all I've done all over the years is that the degree of uncertainty about valuations and what the right price is so high, and that this kind of nuances are meaningless. When I read reports that say the stock has a 10% or even 20% probability appreciation potential, I think this is something that Ben Graham talks about throughout his books. The margin of safety. It says valuation is, it's a very, very risky concept. People do CFAs, and of course there is a discipline of valuation which is valuable, right? You need to know how you studied the Moderan, and it's very instructive to think of valuation discipline and ways to put a value on a company. But the thing is that in reality, there is so much uncertainty, and your terminal assumptions have so much of a weight in your final valuations that in order to feel comfortable, it is wrong to build your confidence in a stock on the precision of your inputs or valuation inputs. The confidence, the degree of comfort has to come from the margin of safety, which is the case where you may be even wrong and quite wrong on the level of valuation, but the price is so low that even if you are 10-20% off, you're still fine.